Investing can be a great way to grow your wealth and plan for long-term goals. But there are some common mistakes that even the most experienced investors can make. And these mistakes could seriously impact your returns and hinder your ability to reach your financial goals. If only I could go back in time and start again. In this video, we are going to cover 6 of the most common ones, and the simple things that you can do to avoid them. And please remember that this is a financial education video and should not be construed to be financial advice. So in no particular order, let's begin with not considering or fully understanding your tolerance for risk. Ignoring your risk tolerance is to not fully appreciate how losses from your investments could affect you psychologically and financially. And lots of investors give this little thought until it is too late, or if they do, they just seek to carte blanche overcompensate for what they perceive to be their tolerance, by either playing it too safe or being too risky with asset choices, with no real plan or understanding of how they would actually cope in a crisis. If you invest in assets that are too risky or volatile for your comfort level, this could cause you unnecessary worry and stress. During market downturns, high stress levels could lead to irrational decisions which result in panic selling, which could result in substantial losses from selling shares at discounted prices. Probably one of the worst things you can do as a seller, but great for a buyer, who will be getting your shares on the cheap. High-risk investments may take longer to recover from large downturns, affecting long-term financial stability. So taking on heightened risk may lead to long periods of stress and significant losses that you cannot afford. Conversely, taking on too little risk, where it leads to you being too over-conservative, could also result in you being left with a portfolio of assets that might not align with your financial goals or meet your expectations. This could affect how much income you have in retirement or impede achieving other financial objectives. And the worry of you falling short could cause you to make irrational decisions and to take on more risk than you can cope with in an attempt to make up ground. So what can we do to better understand our risk profile to enable us to choose investments to suit? Well, maybe let's begin with doing some research. Start with accessing one or more of the many financial quizzes that are free and available out there from reputable investment providers such as Vanguard. By answering a series of questions that take into account your risk tolerance, objectives, time horizon, and financial situation, these questions will help determine the asset allocation you should have in your portfolio. And when you know your asset allocation, you will understand the annual return this should provide to you before you then make use of online calculators to help you determine what you need to save and invest over a given period to reach your goals. These calculators will help you understand what you need to be saving each month and how long you need to reach that target in line with your asset allocation. The one on Martin Lewis's MoneySavingsExpert.com website works well and gives you an idea of how to reach your objectives. Put in the expected return of your asset allocation and you can then play about with the other numbers, monthly deposits, investing timeline, etc., to set realistic goals. By understanding and respecting your risk tolerance, you can make more rational and informed investment decisions, reducing emotional stress and increasing the likelihood of achieving your objectives. And the mention of asset allocation takes me nicely on to common mistake number 2, which is failing to diversify. Picking the right mix of investments can help you achieve your financial goals without exposing yourself to excessive risk for your given circumstances. For example, someone who is young with a long-term investing timeline and saving for retirement might have a more relaxed attitude to risk and may be more proactive in allocating more or all of their portfolio to shares, as shares, albeit more volatile than bonds and cash, have historically returned more in the longer term. Whereas an older person who is near retirement might be more risk averse and want to reduce exposure to those equities. Diversity is a great management tool to safeguard you against putting all of your money into one or too few asset types or individual companies. Imagine that you put all of your money on one US tech company, only to find out the next day that a Chinese company could produce AI at half the price. The share price of the US company that you're betting on is likely to plummet, and that company might even go out of business over time. You would then lose all your money. But if you invest in a lot of different companies from various sectors, such as financials, pharmaceuticals, and industrials, that tech company's performance would weigh less on your portfolio's value. And if you understand your risk profile, you can create a diverse portfolio to suit your needs. And you can still diversify even if you are that young person who wants to be invested 100% in stocks and shares of companies to maximize growth. Examples of this would be to invest in a fund that consists of many companies, such as one that tracks the S&P 500, which is an index of the top 500 US companies, or one that tracks the FTSE All-World Index, which includes thousands of the top companies across the globe. And by mixing the funds of different asset classes, you can achieve even greater diversity, as different asset classes often perform differently under the same market conditions. And an example of this is the relationship between bonds and equities, whose prices often move in opposite directions. And this effect can dampen the price volatility you would get from just being invested in stocks and shares. This is called negative correlation. Persons getting closer to retirement or more risk-averse investors often increase exposure to bonds to provide more price stability in their portfolios. By being too narrow in your investment choices, you could also miss out on growth opportunities elsewhere. So if you fail to diversify by relying too heavily on one region, asset type, sector, or company, you could experience significant losses and severe price volatility in your portfolio that might be more than you can tolerate or afford. And you might also miss out on potential growth areas that a diverse portfolio would have provided. So let's go through what we can do to make our portfolios more diverse. We can spread investments across different asset classes such as stocks, bonds, real estate, and commodities. Invest in a mix of domestic and international markets to capture global opportunities. Include investments from various sectors to reduce industry-specific risks. Invest in funds that could do this diversification for you by investing in thousands of companies across different regions and sectors. Invest in ready-made blended funds that many fund providers offer, where they provide the diversity of including thousands of companies from different regions and sectors, whilst bringing together different asset classes, such as equities and bonds, in a mix that can suit your risk preference. Moving on to common mistake number 3, which is to overlook fees and charges that you might incur from investing. A good investor will look to try and keep the cost of investing as low as possible. There are many things you can't control, such as how the stock market performs, but you can control how much you will pay for the privilege of investing. And this illustration shows how even small fees can reduce the compounding effect and reduce your returns in the longer term. And there are various fees to look out for, such as broker commissions and transaction fees, for buying and selling investments. These will not always be apparent, but someone, somewhere, will be making a cut as a result of your transactions. Another fee that you'll encounter is a custody fee, also known as a platform fee if your account is online. This is a fee that your stockbroker or investment platform will charge you for holding your investments. Some come in the form of a flat monthly fee, so the more investments you hold, the cheaper this cost will be as a percentage. Some charge a percentage of what you hold with them, which might be good for investors who are just starting out with smaller amounts. And some charge you differently depending on the type of assets you hold. For instance, AJ Bell charges less if you hold mutual funds with them, whereas Hargreaves Lansdown charges less for exchange-traded funds. There are investment platforms such as Trading 212 and Invest Engine that don't charge any platform fees for holding your ETFs. The mutual funds and ETFs that we just mentioned are pretty similar in their objectives, so I'm not going to worry about that too much for this video. The main thing to know is that both can help you achieve diversity in your portfolio. Another fee to look out for is those funds admin fee, which is known as an OCF, ongoing charge figure, or total expense ratio, TER. This is a fee that those funds charge for keeping everything in proportion. So what can we do to keep fees low? Firstly, compare fees across different platforms and brokers to find the most efficient choice for you and your circumstances. What could be cheap for one investor might be more expensive for you depending on what your objectives are. Investing in funds rather than individual stocks and shares could save you money on the many more transaction and commissions you have to pay, as you can then reduce your trading by not having to buy or sell stocks so frequently to maintain balance in your portfolio. Investing in funds also gives you access to zero platform fees with certain platforms if you choose ETFs, and reduced cost with many others depend on your structure of funds. And sticking to funds traded locally in your own currency can reduce foreign exchange fees. Keeping your transactions to a minimum, only trading when necessary in line with your strategy and not on impulse, will help to reduce those commissions and transaction costs. Consider if selling one similar investment for another is cost effective when taking transaction fees and commissions into account. Choose passive funds over active ones, where ongoing charge figures will be higher to pay a fund manager more in their all too frequently failing attempts to try and better market returns. Use comparison sites such as jessetf.com to compare OCFs or funds. If you know what your asset allocation should be, for example 60% in a global equity fund, then use this site to compare the different costs of the different global funds available. And finally, check that the type of account you'll be using, general investment account, pension or ISA for example, does not have a different pricing structure with your broker or platform. Which is a nice segue to the next common mistake, which is not being tax efficient. With every budget comes greater tax penalties for investors. In the October 2024 budget, capital gains tax rates were lifted from 10% to 18% for basic rate taxpayers, and from 20% to 24% if in the higher tax bracket, for any profit made from investments over your £3,000 capital gains allowance. You also have a separate £500 annual dividend allowance. Dividends are what some companies pay you as a shareholder, and you will also get these paid out from the companies in funds. On anything above your allowance, you pay 8.75% as a basic rate taxpayer, 33.75% as a higher rate taxpayer, and an even higher 39.35% as an additional rate taxpayer. When saving cash, you pay tax at your personal rate of income tax on any interest earned annually above £1,000 as a basic rate taxpayer, or £500 as a higher rate taxpayer. Given that interest rates are higher these days, you are more likely to use up these allowances from better interest rate returns, meaning that you are now at greater risk of paying higher rates of tax at 20 or even 40% on your hard-earned savings. Why is this generally a good thing to make use of the tax allowances that you have? Why would someone potentially unnecessarily risk paying these taxes? You could alleviate most of them by ensuring that the accounts you hold with your broker or investment platforms are tax-efficient ones such as ISAs or pensions. You have an annual allowance of £20,000 to pay into a stocks and shares ISA, for instance, and all investments can then grow tax-free and be withdrawn free of tax at any time. With pensions, you get 20% tax relief added to anything you deposit, up to a massive £60,000, including the tax relief that you get from the government, or your annual earnings, whichever is the lower. Yes, you do pay tax on withdrawals at your personal rate of income tax, above that annual personal allowance. But the fact that 20% tax relief is added to what you put in means that your investments can grow much quicker, with additional money being added for that compounding effect to be even better. And you do also get 25% on withdrawals or lump sums tax-free. This 35-year investing illustration shows how being tax efficient can prevent it being a drag on investment performance in the long term and increase the chances of you achieving your financial goals. Another mistake that investors commonly make is allowing emotions to influence financial decisions. Being emotional about investing can severely impact investing decisions and often lead to suboptimal outcomes, where you might lose money or not achieve the gains that you would have had you been balanced and consistent. Investors can experience large falls in their portfolio's value for many reasons, such as poor market conditions, political decisions, geopolitical events, or because of poorly constructed portfolios that lack diversity. And due to the fear of losing all their money, they see that the only way of halting this is to sell out. And in doing so, you would have just realised permanent losses on investment prices that were probably only temporarily depressed. If past performance is anything to go by, the stock market will recover and go on to new highs. Conversely, emotional excitement during market rallies can lead to impulsive buying at high prices, only to experience losses when markets correct themselves. When markets are booming, investors often get greedy, and this can lead to overconfidence and excessive risk-taking, such as investing in already overvalued assets. Warren Buffett once said that investors should be fearful when others are being greedy, and greedy when others are being fearful, which kind of sums up the two emotional states I've just explained. Investors often have a herd mentality, buying into trends at their peak, with a fear of missing out. Chasing trends, when driven by emotions rather than using rational analysis, can lead to impulsive and ill-timed investment decisions. Focusing on trendy sectors or stocks can result in a lack of diversification, increasing exposure to specific risks and creating higher price swings to a more volatile portfolio. And by chasing trends, investors may overlook other valuable investment opportunities that offer better long-term potential. By having a herd mentality, you can contribute to asset bubbles where prices are driven up by the irrational exuberance of many, only to crash later. Even if they describe themselves as long-term investors, people often take a short-term view and find themselves constantly knee-jerking from what they are learning in the media. This can lead to frequent trading and trying to time the market, which can lead to higher transaction costs and reduced overall returns. Accurately predicting market trends and timing entries and exits is extremely challenging, even for experienced investors. And mistiming the market can result in missed gains or locking in losses. Having a short-term focus can make you take your eye off your long-term goals, resulting in decisions that favour short-term gains over long-term wealth accumulation. And if you thought that the emotional issues that I've already raised were bad, what compounds them is that investors often suffer from confirmation bias, where they proactively seek out information that confirms their pre-existing beliefs, leading to continued overconfidence and poor decision-making. On top of this, they will also ignore contradictory evidence due to their emotional attachment to their belief in certain investments, causing them to ignore warning signs or negative information. By managing emotions and having a disciplined strategy, you can make more rational decisions that align with your long-term financial goals. Develop a clear investment plan with long-term goals and stick to it, regardless of market fluctuations. Constantly checking the performance of your portfolio is more likely to make you want to act when you should be thinking long game. Noise in the media will encourage you to do this, so make a pact with yourself to only check in occasionally and not because of bad financial news, as you will then be giving your investments time to grow, and there is then less chance of you panicking about short-term falls in the value of your portfolio. Follow the principles of dollar cost averaging to invest regularly, and make this easier by setting up direct deposits rather than ad hoc transactions. Invest in stocks because of facts and fundamentals rather than speculative trends. By avoiding the temptation to chase trends, you can maintain a more stable portfolio that aligns with your attitude to risk and your long-term goals. Use your newly agreed self-pact to only check in occasionally on how your investments are doing rather than every day, and then not for impulsive buying or selling. Which takes me nicely onto the final common mistake that investors often make, which is a failure to identify drift in the proportions of your asset allocation. So you will have done some great analytical work to identify your attitude for risk and have then built a stable portfolio that is aligned to your goals and expectations. But all this hard work might be gradually undone if you neglect the fact that you need to occasionally rebalance it. Over time, different assets perform independently, some better, some worse, but causing drift away from your portfolio's intended asset allocation. The better performing assets may become overrepresented in your portfolio and therefore put things out of balance. This can lead to an overconcentration in certain regions, sectors, or assets, increasing exposure to specific risks by there now being reduced diversity in your portfolio. Less diversity will make your portfolio more susceptible to volatile market fluctuations and losses. High volatility can make it more difficult for your portfolio to recover from downturns. As your portfolio drifts, it may no longer align with your long-term financial goals and risk tolerance, which can then cause emotional decision-making such as holding on to winning assets for too long or panic selling during downturns. So how can we overcome this? Maybe start with setting a schedule. You don't want to be doing this constantly because of all the transaction costs that you might incur, but at least set a schedule for rebalance checking, such as quarterly or annually. Then only rebalance when asset allocations deviate by a certain percentage from their target allocation. Consider using the automatic rebalancing tools or services offered by some investment platforms when it comes to doing it. And remember, this is a financial education video. I'm not recommending any specific strategy or investments here, as what you decide has to be in line with your individual circumstances, and nothing in this video should be construed to be financial advice. If this or anything else covered today seems overwhelming or too complicated, then consider seeking advice from a suitably qualified professional who can help create a balanced portfolio for you in line with your risk profile and objectives, whilst developing a rebalancing strategy that aligns with your goals and risk tolerance. I do hope this video has been helpful to you and will hopefully prevent you from making some costly mistakes that many other investors make. If you have any comments or questions, then please reach out in the comment box below, and I will leave some links to the sites that I mentioned in this video in the description box below. Thanks very much for watching.